Welcome to the Truth About Real Estate podcast. Today we're talking with Martin Saenz, an expert in note investing. Martin brings social good into smart investing as the managing partner of Bequest funds. Welcome to the show, Martin. Glad to have you here.
Yeah, thanks for having me on, Matthew.
Great. I was just talking to you at first, and I really want to dive in and learn more about you, how you got into real estate, and how you got into note investing, and why that made that move instead of generally buying single family homes, fix and flips, wholesaling. How did you get into note investing? But first off, let's talk about how did you get into real estate?
Yeah, sure. So I'd say it's about 2004. I was fired from a corporate job, and my wife and I really went on a lifelong pursuit to kind of learn as much as possible about real estate investing, about entrepreneurship. And one of the things we really learned about is that it's great to get into real estate, but you need some form of cash flow and to sustain an operation over time. So we opened up a small business. We founded a government contracting company in '05. And from that point, I just continued learning about real estate. And we bought our first commercial space in '09 that we still own. And we operated our company out of there. We bought the neighboring building. And from that point, we just started buying real estate as a buy and hold play. And to date, I have not rehabbed one home. So I don't know too much about that side of the business. But in 2013, we sold the government contracting company. And I recognized that landlording wasn't fulfilling my financial aspirations quick as I would have liked. And maybe it was because of the operator itself. I don't know, but I stumbled into note investing from that point, and the rest is history. I mean, I've been hooked ever since.
What is it about note investing that made you hooked on that? And what is note investing for people out there who don't know?
Yeah. I'll just give kind of high level, and so there's obviously different industries within note investing and different approaches and whatnot, but generally speaking, you have an individual that's looking to purchase a home, and they go into a bank or kind of connect with a lending institution, and they apply for a mortgage. And if everything goes well through underwriting and they get to the closing table, they're going to sign a promissory note, which is a promise to pay back the money given a certain set of terms. And they're also going to sign a mortgage or deed of trust, which is going to tie that promise to the property in the form of collateral. Now, 4% of all bank originated mortgages go into default for some reason. Generally, it's due to love or someone gets divorced. It's a health-related issue, or someone loses their job. And so what the financial institution will do over a period of time, 2-3 years, they will go and bundle these defaulted mortgages into tranches and sell them into the secondary mortgage market to other hedge funds and lenders. And it's essentially like the secondary mortgage market's essentially like a flea market. And so where there's buying and selling of debt. And so hedge funds like the one I launched in 2013 will go and buy a mortgage, at 20, 30 cents on the dollar. And then you have kind of two approaches from that point. You can exit through the homeowner or exit through the property. And so what I learned early on is exiting through the property is essentially taking back the property through foreclosure, repositioning the property, selling it with seller financing, or just kind of recapitalizing, selling it off as an REO to a third party. What I found is that wasn't the long-term play, and it wasn't what I wanted to do to displace families. So what I did is I built the whole operation around treating the homeowner like gold and treating them with compassion and becoming a compassionate lender, doing everything possible because I purchased this loan at a discount and trying to work with them to keep them in their home while drumming up a payment plan that they can afford while making a profit for the company, of course, in the end. And so that's really what our whole operation's been. That's been the mission of our whole operation since.
Nice. That's actually a smart move too, because like in note investing, you're basically taking on the liability now. For example, the lender chooses to sell it, and then now you're buying that, and they chose to sell it because it's a problem for them. They don't want to carry on the books. They're holding it. They're selling it to you on pennies on the dollar. You're getting the advantage to buy it, but now you have to figure out the strategy. You made a good choice too. Like you're saying, you want to help the current owners there and try to keep them in the home, which is great because they ran into some issues financially for some
Mm-hmm.
reason, and they were paying in the beginning, they were paying their mortgage and everything, but something happened. It
Yeah.
happens to everyone. So now you're helping them kind of recoup and setting up a payment structure, which is really cool because now they could go, okay, well, I'm not getting kicked out of my house. These guys are great. They're helping me stay in
Mm-hmm.
place, but at the same time, I need to pay them back too. I can't just default the whole thing throughout. But then at the same time, some people can't afford it. Then you're
Mm-hmm.
going to have to carry that weight on. Okay, how do I reposition this house? I need to work with the right team, do that work, and then sell the property and then do it all over again. So there's a lot of work to be done
Mm-hmm.
on that side too. But like, how is that compared to like, is note taking easier or is it just different from traditional real estate investing?
So what's interesting is there's a lot of similarities. If I kind of went into our process, there's so many similarities to rehabbing a property with rehabbing a mortgage, and so you're putting a lot of sweat into it. You're putting a lot of resources. There's a lot of legal involved. So there's just you need to build a whole operation and then throw in compliance and state licensing and federal licensing and just there's other complexities too. What I would say is that probably from a physical standpoint, the mortgage side is not taxing. You can do it out of a Starbucks, and we have a whole operation here, but you can do it with a cell phone and a laptop if you're really kind of going at it. But from a resource standpoint, with systems, you need to be conscious of all the complexities with compliance because you could really get caught badly if you're not following state regulations, if you're not following federal guidelines, if you're not using licensed parties like either law firms or servicers. So there's just a lot of nuances that could really catch you badly as an investor.
So even in note investing, that sounds like a lot of liability. Like, as an investor, do I really want to take on all this work, all the liability and all the regulations and just making sure everything's done right? I think it just sounds like it from the high level, like, okay, well, buying and fixing houses, investing, borrowing property, short-term rentals sounds easier, less liability, less work.
Yeah, but from a scalability standpoint, we just bought 394 mortgages a few weeks
Nice.
ago. Imagine buying 394
Yeah,
single family properties you have to rehab.
that's crazy.
So yeah, and that's work for about 1.5 asset managers full time.
Hmm.
So 394 properties. I mean, if you talk about from a property management perspective, or let alone just flipping and restoring and all that, I mean, you're talking about a lot of physical effort involved.
That's very true too. And then, yeah, flipping 394 homes would be a crazy amount of work, and you need teams everywhere. And right now, materials is high, contractors are hard to find, getting the house done,
Mhm.
permitting time is long, everything delays there too. How does that work in like note investing? Like when you're investing notes, it sounds like you mentioned your scalability, so you can scale way faster. How do you manage 394 notes, and like how do you systematize that to actually create return on investment for your investors?
Yeah, so actually, so we have two separate operations. We have a private hedge fund that's owned by myself and my partner in
Mhm.
full. That's the hedge fund that purchases non-performing mortgages, and then we also have the other side of the operation. It's another company entirely. That's a 506c Reg D income fund, and that's Bequest Funds, which is the income fund whereby we bring in investors. So we have like two, and those are only performing season mortgages in the income fund. So kind
Nice.
of two separate sides of the coin, of the same coin. But in terms of managing the process, I wrote a book that was exceeded my expectations in terms of people reading it because it was a
Nice.
bestseller. It's called Note Investing Made Easier, and and it was really at a point in time where I received a spiritual calling to share what I know, and I was in church at the time, and so before I was just kind of doing this in a cave, with my own little network and whatnot. And so I wrote the book. It was like a how-to book. And what I talked about in the book is, the significance of sourcing, building the right relationships, honoring your word, all these other, good business practices. And then also too, from a due diligence process, you need to systematize the whole process. You need to have all the resources in place whereby you're pulling credit you're pulling credit reports in batch pools. You're pulling Pacer background checks with batch pools. You're ordering O&E, which is like title reports, in batch pools. And so and then as you review all these reports and all these data, and you're doing triangulation of data, you do it all like an assembly line approach. And that's how you're able to scale within the note business. And then from an asset management perspective, kick-ass database whereby it's customized to exactly, to fit your culture and your needs, and also kind of mirror what's being done on due diligence and making sure you're pulling that data in. So, and then also too, kind of training the asset managers so that they are compassionate and genuine, and they're giving these homeowners options, and they're speaking to these homeowners with, with dignity and respect and all that. And so just kind of putting all that together and managing it on a daily basis is really where it's been for us.
Nice. So that takes a lot of work. For example, you need operations, you need finance, you need tech, you need some marketing, and you need salespeople and support, a lot of support. And that's a whole different team. Like you have an organizational structure to handle this, while you have the investment group too, to actually create the return on investment for this and calculate the risks involved. How risky is note investing versus just traditional investing? Like, what's the difference?
I think Kiyosaki, answered it well to that question in Cashflow quadrant. And how risky is the investor? How risky is the person who's operating? It just depends on, how much they know, how much or how much they, don't know, and they're not looking to know. And, kind of, so really it's about someone's commitment. So if you're committed to the industry, if you're a student of the industry, if you are putting emphasis towards compliance, you're going to lower your risk. If you're putting emphasis towards due diligence, you're going to lower your risk because you're going to be buying better. If you put emphasis towards sourcing and relationship building with the right sellers, then you're going to have more access to quality product, and that lowers your risk. So it really just matters about the entrepreneur and how they're putting their business operations together in terms of how risky it is.
Nice. And then, these notes are distressed mortgages in real estate. So like when you're looking at these notes and the properties, at 394 places, you're probably looking at different locations. How do you guys, analyze the risks involved for the city, for the area, for the property itself? And like, what kind of, for investors, what kind of returns are they seeing, or what kind of things you can tell about like how the investment structure works when they ask you about notes versus syndications, other funds, and like which one should they invest in?
Yeah. So as far as risk, what's interesting within the note space is that when generally we have real estate folks that come into the note space, they look at it from the prism of real estate. They want to get like boots on the ground. They want to like, how does the roof look? How old are the windows? And, they kind of go that route. But when you're buying mortgages, especially you're buying it at a discount, 20, 30 cents on the dollar, 40 cents in some cases. What you really want to know is you obviously want to understand title. So you want to understand your lien position. You want to understand if your lien's valid. You want to understand if the homeowner still owns the property. Hey, let's start there. But you also want to place heavy emphasis on the borrower and their ability to pay you. So how does their credit look? How does skip tracing look? And then you're going to go compile all this data together and make a determination. You can use like a scoring matrix or what have you to kind of make determinations. And so that's really how due diligence is done, more than just, and you might get it like a BPO, you might get an AVM with all the algorithms kind of pulling FMVs together. But at the end of the day, if you are buying, if let's say it's a $200,000 property and you're buying a $130,000 mortgage for, let's say, $50,000, to me, it doesn't matter as much as if that property's worth $180 or $220. At the end of the day, I'm going to be covered how I need to be covered, and I really want to know, are they going to be able to pay me?
Yeah, and especially if you're buying it, 20 cents on the dollar, that's a huge upside there. So even if you calculate the risk involved with it and taking that difference, you have a lot of room to, hopefully do really good, even if some properties fail at the same time, and some will. The percentage should actually be a lot higher, so your risk and your gain has a lot more room to play with, a lot more wiggle room, right? So, like when you look at that numbers, like how does it work for investors? Like if people want to invest in a fund and you have, good
Yeah.
assets, good notes into the investor group, how does that work?
Yeah. So for what I just said in terms of scenario with 20, 30, 40 cents on the dollar, that's a private hedge fund. So we actually don't have any investors in the
Okay,
fund. It's
you
just
don't
my
have any.
partner and I that own that outright.
Nice.
Now, as far as how Bequest works, so that is where we bring in investors. So Bequest is set up whereby the model's a little different. It's almost like an extension of the hedge fund in that we buy performing mortgages that had a moment in time where the homeowner defaulted but got back on their feet with a loan modification or reinstated, and they re-seasoned the paper by making their payments on time. So they got their job back, they found love again, something to that effect. And again, they were credit folks to begin with. They just had an issue or an obstacle in life, and who can't relate to that? So we will go and buy those from third-party hedge funds for 70, 80 cents on the dollar into Bequest, and which equates to about a 12, 13% yield, which allows us to pay out our investors 9% annual pref, and we pay that monthly. So how it works is investors put in, let's say, $100,000, and if 50K is the minimum to come in, you put in $100,000 and you get $9,000 annually divided by 12, and that's your monthly payment that we will ACH into your account at the beginning of each month.
Nice.
So that's how it works. So we monitor the collectability of that portfolio on a daily basis, and right now it sits at 96%. So 96 out of 100 mortgages are paying on time as they need to. So as those payments come in, we in turn pay our investors. And so that collectability plus investment of value, those two metrics are everything to that fund.
Nice. And that's a good number. That percentage is really nice to hear that. And then, what makes me think about it when I look at a note versus, like, say, a syndication fund, the question some people ask will be like, well, does a note get tax benefits like the other real estate assets do? Do they get, like, for example, mortgage pay down, your tax benefits, the capital appreciation, using cost segregation, like, reducing your taxes really quickly for those out there who want to know about cost segregation? Like, how does that work on a note?
Yeah, so not as favorably.
Yeah.
So what happens is, we have some capital gains events that occur in the fund when we get payoffs. So what we do is we kind of pass those down to the investors. So that the tax savings is generally 25% of your income that you'll earn from Bequest funds will be attributed to capital gains, and in the K1 will kind of spell that out, and then 75% will be considered ordinary income or interest income. So it's not. This is why a lot of people do this through self-directed IRAs to kind of avoid the kind of tax issues. But the tax savings is not as favorable as with real estate.
Yeah, and I would just say it's a different style of diversifying your portfolio. Then you can do some notes, you can do some funds, syndication. You got to figure out for each individual, like, what's the best thing you're looking for, tax savings, benefits, like that. But there's also different kinds of risk associated with each group and different percentage numbers overall. So you mentioned too, we're not tax advisors, but you mentioned too, like, okay, on a note, if someone pays down the note and, like, pays off the mortgage out of 300, let's just call it 300 houses, someone pays down, then you're actually getting a gain on that part of it because they paid you back.
Yeah, so we'll get a capital gain, and so the 9% pref is fixed. There's no waterfall to the fund.
Mhm.
But there's also no fees associated to the 9%. So just 9% means 9%. When we do have a capital gains event with the fund and we do receive a payoff, what we do is we redeploy that capital to buy additional mortgages, which lowers the investment to value for the portfolio. So currently the portfolio sits at 62% investment to value. And that's because we buy these mortgages in at a discount, which makes it a very conservative play. So we're not, there's plenty of guys and gals, they'll give you 12%, they'll give you upside, they'll give you all, and that's great. But there's always some risk associated. Nothing's for free. For us, we just want to be known as a very conservative, boring fund where you don't
Those
have
are
to ever
good.
think about it. You just receive your money in monthly.
That is nice because you can get consistency with that too. And if you have capital events throughout the, let's say, period of 5 years, 10 years, then overall, even in the entire term, starting with 100K, you're getting some pretty good numbers on that. And it can sound boring, but the nice thing about it is cash flow. It's nice.
Yeah. Yeah, that's what it's all about. Is I've been a cash flow investor for many years, and that's where my heart's at. My heart's at monthly income. I can't speak to crypto, and there's all these, I'm sure, wonderful investment opportunities out there. They're above my pay grade, and I just don't do anything for appreciation. Everything in my world is about what I can see in my hand at the end of the month.
Nice. And what kind of risk would be associated with going into notes for investors?
Yeah, so as a business, it's really an interesting time. There is years past, I mean, it was pretty easy to get into the note business. You could go and buy a few notes, and you could be a novelist and just kind of learn as you go about and do. And so those days are few and far between because of compliance. There's a whole slew of regulation that's involved with note investing now. So if you're going to come into the industry, we welcome you. Of course, there's lots of opportunity, and it's a very lucrative industry. But you need to be prepared to scale quickly, and you need to be prepared to deploy capital towards compliance and keeping you out of trouble and doing it correctly, I should say.
Yeah, that's the hard part about any syndication funds, notes, just raising money of other people's money. Then you have to be really in compliant and follow all the like SEC guidelines and everything with your individual industries. That's tough. That's a lot of work to be involved. But yeah, it is lucrative. It can be really a lot of fun too because you have the community, the culture. You're trying to build something. Like even in our syndications, like we were trying to build really good communities. When you're helping multifamily homes, you're trying to build a community and not just raise rents. You're trying to actually create something like create a good area, create all the benefits, make people want to stay, make the community better. And that's a lot of fun. It's kind of like, building houses at a massive scale and creating your own little small pockets of communities.
And yeah, and that's well put. What I would also say, best way to mitigate risk is just to have a culture where you're treating the homeowners with compassion. So if every communication you have with the homeowner shows that you have their best interest in mind, and shows that you're being compassionate, and shows you're giving them options so they can select what's best for them, and if that comes off very clearly, then that will mitigate risk so in so many cases. It's when you could get in trouble, kind of saying the wrong thing, or calling outside the hours you're supposed to be calling, or doing something like that. That's when you get in trouble. That's when a lot of people get in trouble, I should say.
Yeah, you're absolutely right. Like, people out there like slumlords, for example, who put bad rep to the people who are actually trying to do good and trying to help and try to figure out a balance, a fair balance to everyone. Then that's where, yeah, you're right. Being nice is way better than being mean and having to deal with it. And when you're being mean, people will fight back, right? And they'll fight hard, and you create a lot more
Yeah.
issues that way, right? Why not, treat everyone with good respect and try to figure out a balance to find a solution for everyone that, is fair and works. But it's tough because there's some people out there who are trying to abuse the system on
Yeah.
both sides of the fence. So I get that too, and that's not fair for those people who are taking advantage of it.
Yeah, and we've been around the block, so we've purchased hundreds and hundreds of mortgages over the years, and and so we kind of sense out where someone's at, and so what if we have an issue, if we have a difficult individual who just doesn't want to play ball, then we'll just kind of actually leave the community. We won't do much in the form of communication. We'll let our attorney kind of handle that soup to nuts, just to make sure that we're not doing anything out of compliance. We're always very conscious of being in compliance with things.
Nice. When you started doing note investing, like when you first started, like what were the things you were looking up and trying to find and learn about? And what did you learn even after the first year? What did you learn was actually the best way to do it? And how would you redo it again?
Yeah, so I did it through the eyes of a real estate investor initially, and I was looking at, I was just focused on the property, and I actually bought 10 notes in Ohio as my first purchase. And I drove to Ohio and I went and saw the properties, and I just kind of, did my due diligence on the properties themselves. And I really fell flat in that because I placed no emphasis on the homeowner and their ability to pay me. So what happened is, when you don't do that, then you get what you're focused on, and that is the property. And in this case, I got back properties and they had back taxes, and they didn't sell for what I thought they were worth at the auction, and a whole host of other complications, city violations, Shaker Heights, Ohio. Outside Cleveland, they were mowing my lawn for $250 a mow, and I didn't even know. And they were doing that for months. And then I had to resell the property, and they do actual inspections of the property, and they give you punch list items you have to correct before selling the property. And that's the city. I mean, that's not even like, so it's all these buggy, all these buggy nuances. And so that was my first year. My first year was just getting kicked in the butt in every which way. But thank God that I persevered and I stuck with it. And I think what did it for me is, on a few of those mortgages, I got a loan modification. In one case, someone paid me half of what was owed. I think it was like $50,000. They paid me half money down, and then I did a mod for the other half.
Nice.
And so I kind of saw the light, and I'm like, wow, this is where it's at. Get a down payment, get cash flow, and go out and buy more notes. And
nice.
so
That's a smart way because you scale that. Once you started getting the money flowing in, you got down payment half down, then you saw the difference of your equity right there, and then having the consistency come in from the mortgage pay down, and you had the ability to take that money and reutilize it and reinvest and scale it even further. So as you kept doing it, you kept scaling the numbers up.
Yeah, and it's interesting. Like, I think now, I was new, and I was naive in many ways. I still have a lot to learn now. For that matter. But, you look at banks, right? They prefer to give you a 15-year mortgage over a 30-year mortgage. Why? Because the velocity of money, right? They're getting their cash in quicker and able to go redeploy it on another opportunity. Plus, you're paying down, you're buying them equity faster at a faster rate too. So giving them a better cushion.
Nice. That's smart. Yeah. Like, why not copy the banks and what the top people are doing, the institutional investors are doing, and do it at a smaller scale in the beginning, right? As you build up to be their level. It's like, just follow the best things they're doing, the best advices, and see how they're taking action. But yeah, you're right. 15-year is great for them, and a 30-year, versus 30-year, because who wants to wait 30, 40 years for their money back, right?
Yeah. Yeah. I mean, it usually turns around in 7 years. And that's the beauty, is when you build, it's a portfolio game. So we buy nationwide, and to us, if it takes us a few years to work something out, or takes us a few months, we're in it for the long run. And right now, I mean, when you get to a point where your portfolio is big enough and you've been doing this long enough, it seems like every day you're getting a payoff of some kind. Or some huge down payment or whatever. So it kind of all works itself out.
And when you first started note investing, like, how much money does a person need to even start with, and how do they even buy their first note?
Yeah. So when I first started, my first purchase was 240K to buy the 10 mortgages that I purchased. Right now, I have like two schools of thought on that. I think that it depends on how much time and commitment you can place in it, and how much you're going to ramp up your education. That'll lessen the amount of money that you have to put out. Also, too, if you really kind of build yourself in to be focused on deal flow generation, and you're making calls and building the relationships, that's also going to shorten your learning curve, and also it's going to lessen the amount of capital you're going to have to come with. So in other words, if you're known as someone who can drum up deal flow, then money's going to kind of find you, and the clouds will part, so to speak. But if you're coming in and you're not really good at sourcing, and you're trying to figure it all out, I mean, you need pricing's gone up, and there's less inventory on the retail level. Nothing different than real estate is seeing right now. So maybe 100,000, but if you had $100,000. If you had $100,000, I would spend like half of that on mentorship, education, going to conferences, reading as many books as you can, and then putting to work the other 50. I would kind of do it that way.
And that's hard too, because like any investor starting with that money, even though it's the investment to education, it's hard to like let it go, even though we know mentorship and coaching is really valuable and really valid, because you're taking experiences and accelerating it really quickly, and getting rid of the failure points up front. But that initial push to say, hey, I'm going to use this to invest in myself, and the belief of investing yourself, taking the risk, is hard for anyone at any price point.
Yeah.
That is a part of it.
The price of not doing it, the price of not doing mentorship, the price of getting sued. How about the price of getting sued because you did something out of compliance?
Yep.
The price of yeah. So there's a price every which way.
There is, yeah. There's, for example, like, okay, if I can make you a great agent sales and double your business in 1 year, or you can go do your own way and take 2 to 5 years, and the cost of time and the money for that 2 to 5 years is a lot different, right? It's just initial push to let it go and do it.
Yeah, absolutely. I mean, time's a killer. No matter what business you're going to operate in, I mean, you need to work with speed, because there's going to be faster people kind of running circles around you, people that have been running for many years prior to you being in existence. Yeah. So you got to catch up to them.
And when you start doing notes, like, where do you even buy notes at? Like, as a new note investor, where would you even go to buy a note?
Yeah. So, where we buy with peer hedge funds. So these are people we have deep rooted relationships with. We've spent millions of dollars with them over the course of years. And so we know each other pretty well. And so, but for someone new kind of coming on the scene, there's PaperStack. There's, which is an online marketplace portal. What I would suggest is kind of go to some of the note conferences and see if you can find some individuals that are looking to sell off notes. But on the retail level, you have to kind of be careful, because if you have someone that knows what they're doing and they're selling off a few notes to you you don't know what you're doing, then then you don't know what you don't know, and that could be very costly too. So what I would just recommend is not focus on getting into the action in terms of buying a note right away. You need to have a bunch of milestones for yourself, goals for yourself, on getting to know the right people, on learning and building your processes, even though you don't really know what they are. Just read books on it. I've written 4 books on this industry. So I'm all in, and I am very passionate about it. And so read as many books as you can, and just build your systems to the best of your ability. Go to conferences, and just be, see if you can help people, see if you can, in a protege way, find a mentor, pay a mentor. That's the thing, is with mentorship, it's interesting. And I used to mentor in the space, and I don't train right now, but when I did, what I always found interesting is that the mentorships that come free usually are the mentorships you don't want. And so my first mentor is Marty Granoff. And when I came in the space, and how I paid him was deal flow. I actually brought him 3 lucrative deals, and he
Nice.
kind of mentored me along the way as a result. So you got to bring something, either, you go out hunting and you kill something, bring it back to your mentor, or you pay them money or something like that.
I
That's
completely I completely agree, and I think the fastest way has always been mentorship and learning hands on and getting your hands dirty. And the one thing you talked about too is like doing the education up front. You don't want to do it while you're actually live. Like you quit your full time job, and now you're gonna go and you don't know
yeah,
anything. Don't do that. Make sure you
yeah.
spend a year, 2 years, even though you think it's slower. And I know everyone wants instant gratification, but that's not real, right? It's not that easy. And really taking the time and education to say, hey, I have my full time job. I'm gonna do a side hustle, learn about notes, and get the right mentors. I'll go work for
Hmm.
free and be a protege and do everything they need and help
Yeah.
them any way I can. Provide massive value, and hopefully they'll coach you. You can pay them to help coach mentorship, and at the same time learn it and start looking at deals. I think a lot of agents, a lot of investors, they don't always want to go do all the work firsthand and take a year. They want that instant result, and
Hmm.
if they do it that way, it's going to be super hard without actually learning it and being really educated. Because when I look at, for example, when I look at paper stack, I see all these great deals. I'm like, wow, this is cool. If I really sat there and digged in and looked at everything and tried to learn how to analyze it, for example, if I was not an investor,
Hmm.
and see what makes sense, and then talk to people, like you said, network, talk to people, get to know what they're doing, see what they're looking at, see if they're even buying these. Like, if it's so good deal, why aren't they buying it? Right? I gotta look deeper into it now
Yeah.
and figure out why aren't they buying it.
Yeah, absolutely. You can always ask that question. But with that said, we've bought loans from people that know what they're doing and they just miss something.
Mm.
And two, the other thing too is that you just never know when something's going to pop, right? Someone who's kind of given you a rough way to go for a few years, but yet one day they got to sell their home because they're retiring and doing something else. So you're going to get full payoff. I'll say one last thing to the mentorship
Mhm.
tip, if you will, because I'm very passionate about education and mentorship and everything else. I'm a real advocate for it. That you will if you're not going to spend adequate time up front in education and building your systems and kind of finding yourself, know thyself, as Socrates says, then you're going to assume someone else's identity and someone else's business model, because you're not going to know enough for yourself, or you're not going to have enough confidence in what you do and what you're about, where you're going to kind of grow this for yourself. And that only lasts so long when you're kind of living someone else's model or someone else's dream. And you see this on social media like all the time, right? People are like, they think because they're commenting on what you're doing, like they're somehow affiliated to what your success is or something like that. And but the more you spend on education, the more you're really forming your own identity in the subconscious, and that's going to go a long way for sustainability.
Yeah, and I think even like Warren Buffett, he talks about like spending money educating yourself, like really getting proper education to get there. And when I look at it too, like for example, in real estate investing, not everyone has mentorship and does coaching mentorship and learns about it. But when you think about like doctors and professional athletes, don't they all have coaches? Don't they all get mentored? Don't they
Hmm.
have a lot of guidance and like a lot of failures throughout? But they're always being watched upon to really succeed really well. But in real estate investing, even in stock investing, who's really watching out for you and helping you watch for the pitfalls that you haven't seen? Like what you don't know is what you don't know, right?
Yeah. Yeah, absolutely. Yeah, it's significant. And, it's interesting when you mentioned the stock market, because that's really where, when we launched Bequest funds as the boring fund, as I call it, we talk to people. I talk to investors every day. I'm sure you do too, in your line of work with all the syndication and everything. And we find like two types of people every day. We talk to two types of people. They either have a lot of money parked and they're scared, or they're waiting for something, I don't know, or they got like everything, all in the stock market, and it's blowing up and doing so well and everything else. And so we kind of look at ourselves like stress-free investing. So if you want, inflation's going to crush your parked money and anxiety is going to crush you mentally and spiritually in the stock market, because you're going to be neurotically looking at your phone all day.
Yeah.
I ask investors every day, like everybody I talk to, I'm like, they're like, oh, I'm all in the stock market, is blowing up, I'm doing well. Great. How often are you looking at your phone to see what your portfolio is doing?
Every
All
minute, right?
throughout the day. And I'm like, wow. I'm like, that must be very stressful. And then if they're truthful, they're going to be like, yeah, it's taxing. I'm like, you know what, brother, this doesn't have to be that way. I'm not going to make you 30%. I'm not your guy that way, but I'm also not going to be part of your heart attack either.
Yeah, I would get a big heart attack looking at that going up and down. Like, okay, well, stocks. Like, I don't really personally invest in a lot of stocks because, like, I don't want to deal with the headache. I'm busy doing all my other stuff, and I'm looking for passive financial freedom without stress. And like, okay, well, I see what you guys doing. Look at your numbers, and I'm even asking them, even after the fact of your numbers, let's go for a 5-year run. What's the real number after 5 years? And did you get any dividends, tax benefits, write off, pay downs? You go, no.
Yeah.
Let's divide your number in half. What was it really? Well, it's 30%. I'm like, no, it's not, right? And then after the fact, you're like, oh, okay, well, it's comparable, but it's fun. I'm like, yeah, high risk and fun, but unless you IPO something really big, then great.
Yeah.
If not, how is that really comparative to real estate investing, notes, and everything else? Well, those are boring, right?
Yeah.
So,
and it's interesting too, because the whole financial institution is really not looking after you. They're looking after what they can get from you, and in terms of fees, and whether it's the brokerage house or the financial advisor, like they're all fee based, so they're all there. It's not performance based, and so that's a whole other conversation.
And it's a tough one too. And I talk to people about it. I'm like, it's your choice. I've diversify all you want, but like at least take a look at these and consider it, notes and syndications, funds, and see what the difference is and the benefits are. And if it makes sense for you, take a look at it. Right? Yeah, we get it. So that's the tough part about it. So in note investing, like what do you look at when you look at a note or even a portfolio of notes? You mentioned some things like the housing, the AVMs, the properties, the clientele, the owners, and how can they pay. What are some major red flags you see right off the bat when you're taking a look at a note?
Yeah, so back taxes, if they own a
taxes?
lot, if there's a tax lien certificate. So if they're not paying their property taxes, they're not paying their other liens, they're not paying their homeowner's insurance, they're not paying a lot. They're probably not cutting their lawn on regularly, so there's a whole host of things that's going to bring you down. That's a red flag right there. The other thing is, like on the credit report, if they are hyper consumers and they're not paying anybody, it's like blood from a rock, right? They're not, they're going to take you down a long road. But if you so happen to be the one debt that they just forgot to pay, when they got back on their feet, then that's good, right? So you kind of look at that flag as well. If they're in prison, they're probably not going to loan mod with you, and so like skip tracing. And yeah, I mean, it's so funny because we kind of see if the house is burnt down, when you get the BPO back and it's a vacant lot. We've seen that too. We've seen crime scene tape on the pictures. That's never good. Yeah, the more you do, the more you kind of have a sense for it.
Nice. And then when you look at portfolio, when you look at a portfolio, are you able to look at an individual level and at a whole of all the notes?
So, occasionally you're going to get some opportunities where you get to cherry pick, and those used to be more prevalent in the space when there was more of a retail market for notes. But right now it's with our trading partners. I mean, you're taking mixed bags down. So you just have to price everything accordingly, build pricing matrices so that you're kind of staying consistent with your buying practices.
Okay, so if you buy a portfolio right now in today's market and you're getting a little bit cherry picked, can you see at a high level, you see the portfolio, but at an individual macro level or micro level, are you able to like kind of figure out the percentages based upon like what you see in the performance and say, okay, well, based on this, I'm gonna bid 70% or 20 cents, 30 cents, 40 cents on the dollar. Yeah. You can kind of see it before you buy the whole thing, right? You see a little more detail about the individuals inside.
Yeah. So, first and foremost, we want to know, we buy a lot of junior liens
Okay.
because the quality of the property is generally better than seniors. There's the senior mortgages that trade in the secondary mortgage market generally are lower fair market value properties.
Mhm.
So they're more in rural or urban areas and in blighted neighborhoods and whatnot. But on the junior lien front, our average fair market value is $311,000. So these are good properties in HOA communities,
Nice.
and so we look at we want to know that they're paying their other liens. That's very important. Because that shows that there's emotional equity. They want to stay in their home, and that's the other thing that's really positive about the note industry is a lot of these a lot of these mortgages we buy are on owner occupied residential properties. So these people are raising their families there. And especially during COVID where people are home more, they're gonna be more apt to pay you.
Nice. Yeah, I agree. Because no, which homeowner wants to have their family kicked out of their own home that they own, but couldn't pay for some reason or another, right? And
Hmm.
they probably did a lot of work as a homeowner. You probably have a lot of care into it too. You really put in the value for the most part.
Yeah.
What kind of systems and technology do you use to kind of manage note investing? And even in the beginning, and even now, like how did you scale your systems to businesses? Like what products did you use, or what kind of types of products did you use in the beginning and even today?
Products like software.
CRM, like software CRMs, or like how do you manage
Yeah.
notes? Mhm.
Yeah. So I mean, I used HubSpot, out of the gate. There's some free CRMs. We customize Podio
Mhm.
also too, and that's been a great asset from a you can use it as a customer relations management tool, but also as an asset management tool as well. Right now, we're customizing HubSpot as well from more of a investor relations perspective. We've upgraded to a dialer system,
Nice.
so that's good. That allows us to get more calls in to the homeowners. Gosh, I mean, we're with Credco. We can pull credit. We're with Pro Title USA and some other vendors that we pull title with. Skip tracing, we do. You can use LexisNexis. You can use TLO, and there's a few others.
Yeah, it's funny. It reminds me of a lot of work because even in sales wise, you use fixing tools, you use CRMs, you do all those things. And then as you think about it, like how many systems you actually need to run your business. But as an individual, it's a lot. It's really a lot harder because you're trying to learn all these things, especially as a newer investor or a newer non-tech savvy person. And you want to learn all these systems, it gets tough, right? But if you're seasoned in tech first, and then you start building this
Hmm.
out, and you think about scaling a business, because a lot of people just think of it individual level, but really in investing, you got to learn how to scale the business, like get VAs, utilize tech,
Hmm.
utilize systems, utilize dialers, utilize skip tracing, and like make a bunch of calls to get what you want and help the right people, right? And that's a lot of
Yes.
work, and people don't realize the work involved. They just say, like, for example, even when you listen to like Robert Kiyosaki, oh, that sounds easy, it sounds like a lot of fun, a lot of money, but when you actually
Yeah.
dig into it, it's a lot of work.
Yeah. Yeah, it's a lot of work. And also too, there's also similarities between the fix and flip industry with the note investing business too, because we have a lot of people that come into our industry, and what they do is they will source deal flow, source, and
Mhm.
then they'll get a few notes, and then they'll cut off the sourcing and become an operator and go and work out the loans as an asset manager. And then once those loans work out, then they kick in the sourcing again. And so same thing with fix and flip, right? And then so it's that whole roller coaster ride of existence. But you need to be working each phase of the industry: sourcing, due diligence, asset management, and then portfolio management. You need to be hitting on all those phases simultaneously.
Exactly. And when you think about that, it's like, okay, well, going from a corporate job, for example, a tech job or a corporate job, and now you actually need to be an entrepreneur. You got to build a business, you got to run operations, you got to run finance, legal, sales, marketing, tech, and support. And then it's like, wow,
Mhm.
that's a lot of work. I didn't think I need to get that level. I'm just investing in notes, or I'm just investing in a fix and flip. Well,
Yeah.
if you're scaling your business and trying to make it a full time business and actually create passive income, generational wealth, that's one way to do it. That's why I actually talk about like active investing versus passive. Like, as an
Yeah.
active investor and as a passive investor, what do you really want to do? You want time back, Let the
Hmm.
people who are already doing it for years, let them take care of it, find the
Yeah.
right operators, and then trust in them that they're going to help you invest as well, and try to make smart moves and diversify as much as you want. Look at the benefits and the risk and see if it makes sense. But when people talk to
Hmm.
me about going active, I'm like, you really understand how much work it is involved to do what we do every
Yeah.
day and to build systems, it's
But
tough.
either way, you need discipline.
Discipline, yep.
That's the end of the day. At the end of the day, discipline. If there's any word that I would kind of throw out there,
Mm.
if you're going to be if you work for active income and you want to invest passively, then you need to be well disciplined so that you're minimizing your expenses. You are maximizing, what you can earn in your current position or current company that you're receiving your active income. So you'll have more money to deploy on the passive front. And
That's
if you're an operator, you need to be disciplined, without a question.
And that's a really good word, discipline and execution. Because discipline wise, you think about like NBA basketball player like Steph Curry. Is he disciplined? Hell yeah, probably one of the best, most disciplined person, right? And Michael Jordan, because they really specifically narrow down even the millimeter of the way they shoot and score. And they do it thousands and thousands of times
Hmm.
before they really go out, right? But as investors, we don't all do that, and we're not disciplined enough to really be diligent about exactly your goal, your targets, and what you're doing, and the discipline to make it happen, the
Yeah.
execution behind it. Like everyone's tired, everyone has family. There's COVID out there, so many
Yeah.
issues. But if you're not disciplined, then how do you really become a successful investor to create that financial freedom model where you're
Yeah.
trading your active now money versus your future money, right?
Since we're on the Robert Kiyosaki kick, I'm going to throw out a Rich Dad. He's like, you're gonna pay the price at some point, whether it's early in life or later in life. And no disrespect to someone who's much older working at Walmart or something like that, but many folks, they don't want to be working at the ages they're working. And I'm not criticizing anyone. I'm being very respectful, but it may be something that they wish they could have done differently when they were younger. So put in the work when you're younger if you can, and you'll have a better life down the road.
Exactly. And I think that comes back down to like, even like Will Smith says, and they're trying to create financial literacy, like in elementary, middle, high school, there's not that much financial literacy and real life financial literacy. And that's the
Yeah.
problem too. And I'm like, even for me, I'm teaching my baby, my 5-year-old, I'm teaching them about financial literacy. I'm like, hey,
Yeah.
here, trade candy, trade whatever. Here's money. Here's how it works. And here's what you can do with that money. Here's how much it's worth. You want to buy a toy? This costs $10. This costs $100. How much
Yeah.
time it takes you to get that? Wow. I didn't know that, right? I'm like, yeah, it makes sense. You want to invest? Start investing with me in syndication and start investing stuff like that. But really how that generational money works and creating that financial freedom is different, because why do we work so hard in our day-to-day life, right? How do we make it better and get more time back to enjoy life? Because we only have one life to live. What are we doing to do that? And I think it comes down to education.
Yeah. Yeah. Amen to that. We have a chore. I have 4 children, 9 to
Nice.
3, and we have a chore chart. They do chores. We have everyone has a ledger, so they
Nice.
understand, the money coming in. And we go to the store and they're asking, how much is this? And they're saying, are you paying for it or am I paying for it? And yeah, it's great to hear that kind of way of thinking.
I like what you're doing too. You said a ledger too, and that's really cool. Especially a 9-year-old, 3-year-old, they'll comprehend it really well. And the more you're teaching them
Yeah.
now about it and making them earn it. For example, you want to buy an iPad. Okay, great. You need like 500 hours, for example, right? $1 an hour,
Mhm.
child
Yeah.
labor. But like, okay, well, what does that take? What does that actually look like? Well, if you clean the floor, did the laundry, did this and this. Each one has a different value system, and that value translates to actual money, right? That you translate as a parent to give it to them, but when they look at it, they start understanding, wow, things in life are different based on the
Yeah.
amount of work, effort, and results that you're driven to get. And by doing that, you realize, okay, well, if I did this and this and this, I think it's easier for me. I'm faster at it. I'm better at it. I can do this more efficiently, and I can get my toy faster. Why don't I do that, Dad?
Mm-hmm.
That's kind
Yeah.
of cool. I saw that before too. I'm like, wow, this parent who did it on Pinterest, that's really smart of that person to teach them financial literacy at such a young age. They had a whole scoreboard, and each kid had a set too, regardless of age. Some of the
Uh-huh.
younger kids were beating the older ones because they had more time. It was
Oh,
time.
that's
It wasn't
funny.
because the other one had education, school,
Yeah.
homework first, but then the other one had more time, so they started ramping it up. I'm like, wow, that's a smart little kid.
Oh, that's cool. That's
Yeah.
cool. Yeah, I love to see that financial literacy in young children. And what's very unfortunate is most adults need that
Yeah.
now, like in their 40s, 50s.
And the hard part about that is trust. Like, when they talk to someone and say, "Hey, I need help," but who do they trust? Because is everyone trying to sell me because I don't know? And that's the
Yeah.
part of like what I tell people is like really go ask a lot of people. Don't ask one person and talk to a lot of different people. Hopefully you'll find a balance and you'll find people you trust, and there should be similarities of what they're saying. And then you take it with the own grain of salt, do your own research and figure out what's best for you. And then try a little bit at a time. Don't go through hundreds of thousands in without knowing. You can start at the minimum and start investing more as you feel comfortable with that operator. Like we need to earn their trust every day.
I met a guy yesterday that I know. He manages a social club here in Sarasota, and he did something brilliant. He sold his home. He was a renter 6 years ago, bought a home, sold it 2 days ago, netted $500K, and then took his family and rented out a small house so that he can go and do something with the $500K. And then he was asking me what he should do. And I said, do not put it in the stock market. There's going to be a number of people that are going to have their hands out. Financial advisors this is what I recommend you do. And I told him, I said, don't even invest in my fund. Like, because that's the thing is like, you shouldn't be listening to anyone right now. You should be. So I gave him Cashflow Quadrant.
Nice.
I'm like, read this book. That should be the first step in focusing on educating your mind so that when you do make the right choice, whatever choice that is, it'll be because you fully understand the opportunity and the risk involved and what the returns are, and your financial house is in order where you're going to really grow that money.
Nice. I appreciate that too, because that's the right move too. Like really understand what you want first, your goals first, before we say, "Hey, we'll take your money." No, I don't want your money. I want you to understand what you're doing, and if it makes sense to you, then we'll take your money to help you, right?
Yeah, absolutely. If he comes back and he determines, we're the best fit for him, because and you understand this working with investors, it's got to be a fit. I mean, there's people we've said, we don't need your money. Like at this point of where I'm at, I don't need your $100K.
Yeah.
And with the drama, and
not worth it to us,
Yeah.
We don't want to buy into a headache either, right? We want to make sure all of our investors are protected. Everyone's involved because they want to be involved, and we don't want to say, "Hey, you're coming in now. We're just trying to sell you." That doesn't make sense to any of us in our investor group. So hopefully other people think like that, but always, invest in your education and figure out what's best for themselves.
Absolutely.
One last question before we wrap up. How did you write these books, and then like how did it become bestsellers? What do you think the key traits are that people wanted to read your book? Like and what made it like unexpectedly for yourself, even for me, like wow, you can hit a bestseller. That's so cool because you're just sharing your expertise, your wisdom, and your values.
Thank you. So I have freedom of time. I have a little bit less now because the fund's been growing so rapidly, but there was a point where, like a stretch of time where it's just, I had notes. These notes are paying, it's all passive. So I was able to kind of take large blocks of time, weeks, months away from everything, and just go and put down what I know on paper. But what made them popular is that I hit on the nerve that whereby there's a lot of people in this country that see the warning signs of the direction that they're headed in, and they realize that they only have so much time to go and build out additional streams of income, or to take more control over their financial future. And so whether you're an entrepreneur, born and bred entrepreneur, or you're someone that says, I need to be an entrepreneur, or I'm going to be eating dog food. And so these people that are starting to have a sense of urgency. These are the people that picked up my book, and they're like, I'm not only going to tell you about the note industry, and I'm not going to tell you about the note industry and how wonderful it is for me. No, and I'm on the beach every day and all that nonsense, but I'm going to tell you how to set up a note business for yourself. And I'm going to kind of walk you through my systems and my mindset and everything else.
Nice. Congrats on writing 4 books and becoming a bestseller. That's one of the best amazing things to do. And one thing I like about that too is if you think about it too, I forgot who said it, but basically you're creating a generational legacy, because what happens is these books can't be read by your kids, your future grandkids, and so on forever, right? And that value is so important. Even for me, like when I do this podcast, I hope one day my kids listen to this and their kids listen to it and realize, hey, we try to provide massive value to the global global people out there and like really try to provide education firsthand and really find out the truth about the real estate part of it and how to really invest. And that's like
Yeah.
forever ingrained. And hopefully this goes for hundreds of years, one day, right? That'd be cool.
Yeah. It's funny, like our industry, is considered an alternative investment to the stock market, but real estate, mortgages, lending has been around centuries prior to the stock market ever being a thought in someone's mind.
Yeah.
And so I suspect it will be around, centuries beyond today.
I agree. And I like how they use the word alternative, because it's not theirs, it's ours.
Oh
right?
yeah, it's total disrespect.
yeah, exactly. That's what I'm trying to say.
Yeah.
That's funny. All right. Thank you so much for being on our show today. I'm so glad to have you here, Martin, and to really share the experience of note investing and really help educating. How do people reach out to you? How do they learn more about the books you have? And then how do they learn more about investing in notes?
Sure. I actually mistakenly have my email on here. I probably should have put my name, but yeah, Martin at bqfunds.com. Shoot me an email. I'll send you a free ebook. We connect, ask me any question you want. It's not doesn't have to be about the fund. You can just ask me a note investing question in general, and I'll be happy to respond and connect.
Perfect. Thank you so much. I really appreciate it. It was really educational learning more about notes, how that works, and really appreciate your insights on that because, we really want to help people understand all different kinds of avenues and which one's best for them. That's all we were trying to do out there.
Yes.
For everyone out there, be sure to check out our podcast at The Truth About Real Estate on Apple and everywhere else. And we'll see you guys in the next one. Have a great day.
Thank you.